Hey guys, welcome to Lumovest. This is the second part of our two-part series, where we look at both the bull arguments and the bear arguments to understand both sides' perspectives on whether the stock market will crash again. In part 1, we looked at the bull's argument on why the stock market will not crash again, why they believe the stock market will not reach a new low beyond what we've seen in March. And in this video, we'll look at the bear's argument on why the stock market will crash again, why these investors believe that the market will hit a new bottom in the near future. If you've been following this channel, chances are you've seen our previous video titled Did the Stock Market Bottom?, where we compared the stock price movements S&P 500 during the 2001 and 2008 recessions with what we are seeing now in 2020. We only presented the bear case in that video, and many of you asked us to present a more balanced view. Thanks so much for all the feedback, and we've listened, so we try to make it up here with this two-part series and hope they're helpful. Alright, without further ado, let's jump in. After the March 23rd bottom, the S&P 500 has soared to 2,900, down only 13% from the February 19th peak, a far cry from the 34% decline from peak in March. So why do the bears think S&P 500 will crash again? Why do they think S&P 500 will fall beyond 34%? The first reason bears think there'll be another stock market crash is that they think the recent rally from the March bottom is a typical bull trap. In investing, a bull trap is a false market signal that entices investors to buy stocks at high prices under the impression that the stocks will rise further before they reverse direction and decline. These bull traps are usually short-term stock market rallies that convince investors into believing that the rallies are here to stay. The investors buy into the stocks with a bullish view, believing that the stocks will continue to increase for the foreseeable future. And because they bought in at high prices, when the stock prices reverse course and decline, the investors become trapped in the stocks because selling will force them to realize losses. Hence the name bull trap. As a result of the coronavirus crisis, the stock market declined 34% from February 19th peak to the March 23rd bottom. However, since then, the stock market increased by 31%. With this 31% rally, the S&P 500 is now only 13% off from the February 19th peak. The bears believe that this rally is a classic bull trap. As we explained in our earlier video titled, Did the Stock Market Bottom?, in previous market crashes, the stock market does not nosedive from peak to bottom in a straight line. It gets to the bottom through rounds of decline and rallies, with each rally being smaller than the preceding decline before reaching the true bottom. In this movement, the stock market falls to reach a first bottom, rebounds to a smaller extent of the previous decline, declines again to reach a second bottom, and then rebound again to a smaller extent of the previous decline, and then it declines some more to reach a new bottom. This decline and rebound happen for multiple rounds, with each decline larger than the subsequent rebound, slowly bringing the stock market to its true bottom. So the path to go from peak to bottom will involve multiple turns of declines and rebounds. That's the pattern the stock market takes in the past crashes. The investors who had invested in these rebounds with the belief that the stock market is fully recovering were victims of bull traps. The bears argue that the 31% stock market rally is one of these rebounds. Stock market declined by 34%, then rebounds 31%, which fits the typical pattern perfectly. They believe there's a much greater decline right around the corner, making this rally a typical bull trap. So that's the first reason the bears believe that the stock market has not bottomed. They believe that the recent rally is just part of the natural stock market movement of multiple rounds of declines and rebounds to reach the true bottom. They think it's a bull trap. By the way, if you want to learn more about finance and investing, definitely check out our website. We have a structured curriculum on our platform where you can learn about investing in greater detail. The second reason the bearish investors believe that the stock market will crash again is because the stock market as a whole is highly overvalued. Stock market investors evaluate whether companies are undervalued or overvalued by looking at price to earnings, or PE multiples. PE multiples put the stock price you're paying in perspective with the profits the company is earning. It's the equivalent of price per square foot for companies. When you buy an apartment or a house, you're buying space, so you look at the price per square footage, which puts the price you pay in perspective with the space you get as measured by square footage. When you buy a company, you're buying a piece of the company's profits, so you look at it on a price per earnings basis. In real estate, The higher the price per square footage, the more you're paying for each unit of space and the more expensive the house. The lower the price per square footage, the cheaper the house. It's the same thing for price to earnings. The higher the PE multiple, the more you're paying for each dollar of earnings and the more expensive the stock. The lower the PE multiple, the cheaper the stock. That's the idea of PE multiple. Bearish investors look at the S&P 500 PE multiple and the numbers just don't make sense. On February 19, 2020, which is when the stock market was at its historic peak, before coronavirus wreaked havoc across Europe and the United States, the S&P 500 was trading at 19 times one-year forward earnings. This means that as an aggregate, if you were to buy into S&P 500 on February 19, 2020, you were paying $19 for every $1 of profit a company is expected to earn next year. How does this 19 times compare with historical valuation levels? The stock market traded on average 16.7 times on a 5-year average, 14.9 times on a 10-year average, 14.6 times on a 15-year average, and 15.5 times on a 20-year average. As you can see, even before the crisis, the US stock market was already trading at bloated multiples, way above historical levels. In fact, the last time the United States stock market was trading at as high of a PE multiple as 19 times was back in May 2002, after the tech bubble busted and stock market crashed. And now, in May 2020, after coronavirus has caused unprecedented economic damage across the country, the S&P 500 is trading at a forward PE multiple of 22.8 times. So at the current S&P 500 level, you're paying a higher multiple to buy stocks now than you were paying on February 19th, before the coronavirus crisis in the US even happened, and February 19th was already a bit overvalued by historical standards. In other words, stock market investors are paying a premium to buy stocks after the coronavirus than they did before the crisis, and the price before the crisis was already overvalued. Does that make sense to you? Imagine you were looking to buy a house on February 19th, and the price for that house was $19 per square footage. Then a hurricane of record intensity came and completely disfigured that house. Then after the hurricane, the seller comes to you and says if you want to buy this exact same house that's now damaged and at risk of potentially collapsing and probably need a ton of money to repair itself, you now have to pay $22.80 per square footage. The price per square footage to buy this damaged house just went up thanks to the hurricane. What would you say? Let us know in the comments. The bulls argue that the long-term prospects of the economy is intact, but the bears argue that this doesn't change the increased risk and damaged businesses that you're buying. So the bears believe that the current S&P 500 level is highly inflated and unsustainable. It means that investors would pay a higher multiple now during record unemployment and during a historical level of economic recession than they were paying before the coronavirus crisis. Said differently, they believe that the stock market is way overvalued at the current S&P 500 level, and eventually, the bubble will burst, stock market will crash, and the PE multiple will revert back to the mean. The third reason the bears believe that the stock market will crash is because the economy is in shambles in the wake of the coronavirus crisis. On the job market front, unemployment has already reached 14.7%, the highest since the Great Depression. Government officials are already managing expectations and guiding the public that unemployment rate could reach 20%. On the business front, a wave of corporate bankruptcies is already sweeping through America. J. Crew filed for bankruptcy. Neiman Marcus filed for bankruptcy. J.C. Penney is preparing to file for bankruptcy. Hertz, the car rental company, is preparing to file for bankruptcy. And these are just the big names. There are many other companies either already bankrupt or preparing to declare they're bankrupt in the coming weeks. By the way, just so there's no misconceptions, bankruptcy does not mean the business will cease to exist. Bankruptcy just means the company doesn't have enough money to repay lenders who loan money to the company. The company can't repay the loans. The owners of the company will lose their ownership in the company, and the ownership of the company is often turned over to the debt holders as a way to compensate them for the debt. So it's disastrous to the equity holders of the company because they lose their ownership. It doesn't mean companies like J.C. Penney and Neiman Marcus won't exist anymore. It just means that current stockholders get wiped out on their investment, and companies will get a new batch of owners. In the first quarter of this year, the United States economy contracted 4.8%. Again, the largest since the Great Depression. Second quarter GDP is expected to fall by double digits, which would be a historical record. In the full year 2020, the US economy is expected to decline by over 5%. Yet, despite this backdrop of the economy near an all-time low, the stock market is currently trading near an all-time high. So what this is saying is that the companies you are buying are doing really, really badly. They're losing a lot of money and operating in the worst environment since the Great Depression. That's the economic reality. However, if you want to own a piece of these companies that are currently operating in the worst environment since the Great Depression, you have to pay record high prices. Looking at past economic recessions of the century, the stock market declined by approximately 50% from peak to bottom. During the Great Depression, the stock market declined by 86.2% from peak to bottom. By contrast, the US stock market has only declined by 34% from the February peak to the March bottom. This feels extremely small given the magnitude and the acuity of the economic harm caused by the pandemic. Therefore, looking at the current crisis from this historical lens suggests that there's potentially much greater downside ahead. Logically, it's difficult to see the stock market continue to go up. If it keeps going up, it'll reach the February 19th peak soon. We've never had a situation where the stock market trades at all-time high during severe economic recessions. But maybe this could be the first. Thanks for watching this video, guys. If you like this video, please share it with at least one friend. It'll help us get more views and grow faster, which allows us to make more and even better videos for you. Thanks so much, and see you guys next time.